let's talk about options for just a second, because if you don't know anything about options at all, you really need to have a firm grasp of what options actually are. Actually, options, when you think about it, I mean, they use the word option, but you can think of options are more contracts than they are anything else. They really are a contract. And a call, I mean, the definition of a call is really definition of a call option is a legally binding contract that allows the purchaser the right but not the obligation to purchase a particular number of shares of stock at a specified price, which is the same as a stock strike price, at any time prior to its expiration. And that's the one thing that you really need to understand about options, is that options do expire eventually. They may have value or they may have no value at expiration. But the one thing that you can be certain is that they will expire. Some of them are short-term options, some of them are longer-term options. You can purchase an option that expires the next day, or you can purchase an option that expires 3, 4, 5 years from now. So there are, if you think about options, an option is simply a contract. It's just an agreement between you and someone else. Now, if you're buying an option, if you're buying a contract, okay, that means that you believe that the price or the value of that contract is going to be higher at a future date than when you purchased it. The other side of the trade is someone who writes that contract, who sells you that contract. And that person believes that the price will be lower than in the future than it is at the time that they write it. And that's how they make their money. So you have one person on one side of the contract who believes that the contract is going to be more valuable in the future. You have a person on the other side of the contract who writes that contract who believes that the value is going to be less in the future. But it's not that one-dimensional. The fact is, the person who writes you that contract, who sells you that contract, may also hedge that contract with other options. So he may go into the market and place a corresponding trade on another option that hedges his risk in case he is wrong, and that contract actually goes up in value rather than down in value. So as an option buyer, you also want to be able to hedge your bets. One thing about being an option buyer is that, in fact, there's only really two absolute rules when it comes to being an option buyer. Number one is your contract will fluctuate in value. Number two is that contract will expire at some future date. Those are the only two absolute rules of options. Again, those rules are, number one, it will fluctuate in price. Number two, it will expire at a future date. If you think of options only as a contract, you're simply buying and selling different contracts. And you're betting really on the future value of that contract. It's been said a lot of times, and I know it's absolutely 100% sure and absolutely true that the stock market and the option markets is the biggest casino in the world. And it's right, except for one thing. When you go to a casino and you place a bet, let's say you go to the roulette wheel and you place a bet on black, let's say you bet $100 on black, and it comes up red, well, you lose that $100. You don't get that back. You lose 100% of your bet. In the stock market, when you place a bet, let's say you buy an option contract, well, number one is the price will fluctuate. That's the number one rule. The price will fluctuate. So what will happen is you can place a bet, a $100 bet on an option, and 3 days later, let's say the price has gone up. Well, not only do you get back your original investment, but you also make a small profit on that, or you may make a large profit on that. But you get back your original investment plus a profit if the price goes up. If the price falls, well, you get a portion of your investment back. You were totally wrong, but at least you get some of your money back. In the casino, if you're wrong, you don't get any of your investment back. So that's the major difference between the stock market and a casino, is that when you place a bet in the stock market, if you decide that you're very, very bullish on a particular stock, and you buy a call option that hopefully will increase in value as the stock increases in value. And if you're totally wrong and the stock falls, you can get out of that contract with at least some of your money back if you act prudently and quickly enough before expiration. So that is the major difference between the stock market and a casino. Now, what happens if so you have two types of options basically. You have the call option, which allows you to purchase a contract that gives you the right to purchase the stock at a particular stock price in the future. And then you have a put option, which is also a legally binding contract that allows you to the right, but again, not the obligation, to sell a particular number of shares of stock at any time in the future before its expiration, whether or not you own the underlying stock. And they may get a little confusing, but let's use this analogy. Let's say you own a home. Let's say you own a home, and you don't keep track of the market very well for your home, and other houses in the market have sold recently, or they were sold in the past, and you had no idea, you didn't keep track of what they sold for and what prices people were getting for them. And someone knocked on your door one day and said, "You know what? I like your house. Would you be interested in selling it to me?" And you say, "Well, it depends, Look, I'm interested in buying your house for $1 million, but what I'd like to do is say, I'm not really sure if I can get the financing or whatever, and I'd like 90 days to decide. But within that 90 days, I'd like the option to be able to purchase your property for $1 million. In exchange for you holding that property for me for 90 days, I'll give you a $500 deposit. And whether I buy the property or I don't buy the property, you get to keep that money." And boy, if you were the owner of that property, and you know that you only purchased that property for $300,000 just a few years ago, the prospect of actually selling your property for $1 million might be very attractive to you. So you enter into a contract with the person. He gives you a $500 deposit premium on the contract to hold the property for 90 days, and if he decides to exercise that option to purchase your property for $1 million, you'll have made a $700,000 profit. Now, the person who owns the contract, who wants to purchase your property, knows that there is a huge development going on near your home, and they're putting in, some super duper shopping center, and all of a sudden your property values are going up tremendously because this is a great place, and there's a resort going in there, and all of a sudden the properties in that area are going to double and triple in price, and you didn't know anything about that. So you took his $500, and now if he does not decide to come back and buy your property for $1 million within 90 days, then you get to keep that $500, and no harm, no foul. If he does come and purchase your property for $1 million, well, you've made a good deal of money on it, plus you kept the $500. the guy doesn't get that back, even if he does purchase your property. So that's really the analogy. I mean, the guy who's buying the option to purchase your property is hoping that values, or he'll be able to sell your property for even more than $1 million before that 90-day contract expires. And that's what he's betting on. But you know what? What happens to that contract over time? Let's say the start is today. He gives you the $500. You enter into the contract to sell your property to him for $1 million. Now he has the right to buy your property for $1 million, but he's not obligated to do that. So he doesn't have to buy your property for $1 million. Not like a purchase contract like you would when you buy your home, but this is just an option to hold the property and to buy it in a future date for $1 million. So he goes out and he tries to find someone else who is willing to take his contract and purchase your property for $1.2 million. So he's hoping to make a $200,000 profit on that property. If he finds someone who's willing to purchase your home for $1.2 million, he comes and he before the 90 days is up, he tells you, yes, hey, guess what? Hey, I'm going to buy your property for $1 million. And you are ecstatic. You are very, very happy about that. So he buys your property for $1 million. He already has a buyer for $1.2 million. He turns around and sells it to them for $1.2 million, making a $200,000 profit himself. And you have $1 million in your pocket where you can go out and buy another property. But what happens if he can't find a buyer? Well, if we started the contract today and 90 days later it expires, what happens to that contract over time? Well, if the 30 days pass by and he still hasn't found a buyer higher than the purchase price that he's asked you that you'd be willing to sell it for, then the value of that contract should actually go down a little bit. So instead of worth, it maybe originally it was worth $500, now maybe it's only worth $450 because 30% of the time has expired, has eroded that contract to the point where now instead of 90 days in which to find a buyer, he only has 60 days in which to find a buyer. So the probabilities of him actually finding a buyer at 90 days was much higher than it is at 60 days. And then let's say another 30 days has gone by and he has still not found a buyer for the property in which he can make a profit. Well, that contract now is worth even less money. Maybe it's only worth $250 because two-thirds of the time, 60 days have passed and he hasn't been able to find a buyer. So the contract that he has entered into with you is now worth less because there's a much lower probability that he is actually going to be able to find a buyer of $1 million or more. Actually, more than $1 million, because if he buys it for $1 million and he can only sell it for $1 million, he's not going to make any money, is he? So he needs to find someone who's willing to buy it for more than $1 million. And now 60 days have passed and he hasn't been able to find anybody. So that little contract that he has, the option to purchase your property, is going to be worth a lot less. Well, in the last 30 days, he still hasn't been able to find a buyer. And guess what? At 90 days after you originally entered into that contract with him, that contract date has expired and he hasn't found anyone to purchase the property for more than $1 million. But since he paid you a premium $500 and the contract expired, you get to keep that $500, and now you are no longer obligated to sell him the property for $1 million. So that's essentially what happens when you go to buy a call option, an option who is hoping to profit from the price increase of a stock.